Firstly, thank you, Yoram, and thank you to Mr. Lin for giving me the opportunity to share this week with you. Really, it was a really wonderful opportunity for me, and I appreciate the opportunity to present it to you today as well. We've got a lot to go through because there's a lot going on in the diamond industry, a lot of changes. And the truth is that change is, it's the only constant that we've known over the last 2 decades, really, because the industry keeps evolving, and that wasn't always the case. So I want to go through some of those changes that have occurred over the last two decades, really. But really, I've been asking myself the question that gives us context to that background: is why haven't we seen real growth in the diamond industry for the longest time? And these are De Beers numbers that show global diamond jewelry sales since 2008, and you can see that it grew fairly steadily from the downturn from the financial crisis, and then kind of flattened off through to 2019, some incremental growth. And then the COVID happened and the market fell off, and then we had this wonderful recovery in 2021. But the market's come down again in 2023. That's my estimate, a guesstimate, I guess. And you have the same sort of pattern when it comes to global polished demand. We're not seeing this on the screen. When it comes to global polished demand, that again, we're not seeing a real strong growth curve in the market. And so why is that? And what's preventing that growth in the industry? And so I'm not sure if the industry has really tackled this question. And, when I ask people, and I throw out the question to you all, why aren't we seeing? What are the reasons that might be contributing to this? And often the answers I would get is that we don't have the marketing that we used to. The diamond is forever. It's not. It hasn't been pushed to consumers, and that's really actually the main focus that people give me. But I think it's much deeper than that, and I think it relates to that original question that we had about the changes that affected the industry over the last 2 decades. And I don't think we quite understand the extent to which this market has evolved. And so I'm going to take a bit of time to go through a bit of a history lesson on a superficial level, maybe. But if we look at since 2000, I look at the industry in different sort of eras of development. You had the 2000 to 2007, where it was really an end of the old way the industry operated for a century. Then there was the financial crisis. From 2012, there was this e-commerce expansion. We hit a new sort of a bit lower, but a peak production in 2017. 2020, we had COVID, and that brings us to where we are today. And so I'm going to go through each of these little periods with you, if you bear with me. So what happened? It's the end of an era between 2000 and 2007. So we had some very real landmark developments during this period: the creation of the Kimberley process, the final end of De Beers supply control, and the emergence of that Alrosa sales channel that competed with De Beers and had a similar impact on the rough market. De Beers shifted from generic marketing to a branded focus with the introduction of Forever Mark, and stopped these category marketing spend that they had for so long. And this period was also a period of strong retail inventory, that jewelry retailers were very comfortable to build up inventory because they were selling it and they were turning their inventory fairly easily. On a more global and macro level, we saw the launch of Facebook in 2004, Twitter in 2006, and the first iPhone was not that long ago, 2007. And these had a profound impact on what we're experiencing in the market today. So came 2008, and we had the financial crisis, and then the subsequent quite strong recovery actually. But what happened? What did the financial crisis do for the industry? So, in my estimation, that there were two major events that or influencing factors. Firstly, it changed the mindset of retailers, because that generation of jewelry retailers, as we said, they were used to holding large inventory, and suddenly the market crashed and their inventory lost value. And so they learned about caution and were cautious to hold inventory again to that extent that to sort of hedge their bets and mitigate the risk of holding that inventory as they experienced in 2008. The second very important thing that happened was that compliance became front and center in the regulatory environment, and the industry was forced to raise its compliance game. This was really mainly driven by the banks, and also De Beers and Alrosa required of their clients to start reporting, reporting according to IFRS standards and really keeping proper books. So that whole handshake culture that we had in the industry and the Mazalu Bracha was no longer enough. You had to show proper documentation for many reasons. Importantly, during this period, there was this explosion, major expansion in China. We saw the likes of Chow Tai Fook really opening stores across the country very aggressively, and they required inventory to fill those stores, and that really stimulated a boom in the industry from 2009 through 2011. But it became kind of a bubble market, and as we all know, that speculative bubble kind of popped mid 2011. I guess when that expansion, the expansion was maybe over aggressive, or there was an expectation that it would continue at the same rate, and it was not sustainable. So the boom stopped, and we've seen a downturn ever since then. The other thing during this period, importantly, was that the issue of Zimbabwean rough came to the fore. That there was an incident in the Marangi fields in Zimbabwe, and that was the first time that really the industry was forced to discuss these the issue of responsible sourcing outside of the Kimberley process definition of a conflict diamond, because it was a government entity that was involved in the perceived conflict on a diamond asset, and so it shifted it was the first time we shifted the conversation in a very public way away beyond the Kimberley process, and it also introduced what we're dealing with now, that issue of substantial transformation. And so at that time, the manufacturers were asked the question, can you separate Zimbabwean rough from the rest of your production? And it was a very deep question. It was unheard of. And the answer was essentially no, we can't, because of the systems that we have in place. Brings us to 2012, and I think this was really the era of online expansion and the e-commerce expansion on a general retail level, that we saw more purchases being done online, and really social media becoming more important and central to the way consumers started to interact with brands and products. That became the central marketplace for the consumer. We also saw a shift to a more cautionary environment in China, and overall that retail caution across the board continued in terms of the restraint in replenishing inventory in a major way, as we had in the early 2000s. Very importantly, the Botswana beneficiation story really took hold during this period. De Beers moved all its operations from, its site operations, its aggregation operations from London to Gaborone, and Botswana became sort of an independent manufacturing center, as manufacturers were incentivized to set up factories there if they wanted to get rough. And finally, the RJC during this period, the Responsible Jewelry Council, really went out aggressively to gain membership. And very interestingly, again, if we think about the evolution of the responsible sourcing discussion, beginning with the Kimberley process, going through that Zimbabwe experience, and then the RJC came along, and that same question was posed to the RJC in a different way, because the RJC approached diamonds not from a chain of custody point of view, but from a code of practices. That's, in other words, saying that you need to deal with provenance rather than being able to track the diamond throughout the supply chain. And they have that for other products like gold and others, but the RJC always claimed that you can't do that for diamonds. It was too complicated. Excuse me as I navigate the Zoom. Okay, so came 2007, and this was a period where we saw 3 new mines open up, and as you can see here, that before the financial crisis, we really had a strong, a high level of rough production, and that dropped off in 2008 and set a new low bar for rough production for many reasons. Because De Beers was selling off a lot of its mines around this time. Petra Diamonds took over the Cullinan mine, Finch mine, etc., etc. Many of the smaller mines became uneconomical to operate during the 2008 crisis, and demand dropped, and the industry suddenly realized that they needed less diamonds to satisfy what the demand in the market. And maybe the story is actually over here, that there seemed to be this ecosystem that of being able to have excess diamonds in the market and sustain an industry in a very dynamic way. Whereas in 2008, the market shifted to a point where it became more supply-demand, looking for that supply-demand equilibrium. What happened in 2017, 18, we had the Gachapue mine open up, Likabong and Renard. So those 3 mines all added about $6 or $7 million carats to the supply chain. Interestingly, only one of those are operating today, so it's maybe a side story. But we see that was kind of a period of peak production, which then led to a build-up of inventory in the midstream, because with all that extra rough coming to the market, De Beers and others were pushing all that rough to the industry, and so the midstream prior to this period as well, but I think it really intensified here. The midstream became the bearer of inventory risk. And whereas before, as we mentioned, the retailer was happy to build up inventory, they grew cautious, and the midstream became the holder of inventory in the industry. Another very interesting thing that happened for the midstream over this period is that it really doubled down on online trading, and we saw the major manufacturers, the major suppliers of polish really go and invest in their online capabilities to be able to sell with confidence a diamond within the trade online, because we saw better imaging technology and a really a broadening of transparency in terms of the qualities and information that you have about a diamond that gave the trade confidence to trade online. And then it was also a period of the introduction of this blockchain traceability story that we hear so much about today. Okay, 2020 to 2023 was the COVID era. We had COVID, we had a great recovery in the United States, and now we're kind of trying to find our place in the market. It was also a period of increased trade tension between China and the United States, and lower production as the Argyle mine closed down. And as we all love to talk about, it was a period of lab-grown growth. That really was a period when the lab-grown industry infiltrated the rest of the industry and found its permanent place in the market. Again, we're still dealing with this midstream inventory build-up. As 2021, 22 were great years, so people bought a lot of inventory in the market, not learning their lesson from 2011, thinking that the good times would be sustained. They weren't, and so we saw in 2023 that the markets, the midstream held a lot of inventory, and so the markets kind of, the market froze, as we know. And so all of this little history lesson leaves us with this perfect storm of change. If you think about how the industry operated prior to 2000, and that whole wonderful history of the industry over a century, we saw the end of a single rough sales channel, e-commerce boom changes consumer habits, there's a shift to branded marketing, a raising of compliance standards, chain of custody issues start to be discussed in a more serious way, and it's a question of provenance versus traceability, as was mentioned yesterday in the panel discussion. And we had online trading with manufacturers being more vertically integrated, the midstream inventory build-up, and the result, which I think is a pertinent one for this audience, is that dealers started to get squeezed out of the market, and really the question of how dealers are navigating the market in this environment is an important one for the industry. So how do we grow as an industry in this environment? It's kind of understandable that we haven't had that more sharper increase in global sales and growth within the industry, that it seems to be consolidating and contracting rather than expanding and growing. And particularly in the midstream is seeking margin. And so there's this vertical integration that's taken place, as I mentioned, and that's led to some crowding of the market, whereby the midstream finds itself competing with its supplier and its customer. If you go, and that makes for a very difficult environment. The question is there enough margin to sustain the dealer market? And we'll return to this question when we look at the lab-grown sector in a bit. And so I'm seeing consolidation, and I think that this theme is going to continue. How do we know that it's going to continue? Because we've got to look at what the issues are that we are facing in 2024. What are the big stories that are affecting big change in 2024? And we have these 5 issues that I'm going to go through very briefly. The big stories today, as we know, there's the economy that's affected the market last year and this. There's the geopolitics that we've discussed at length, the lab-grown market being a competing product to natural. There's the Botswana De Beers story, which has kind of moved to the shadows a bit, but it's really going to have a profound impact on the way this industry works and operates in the future. And then there's the sustainability story, which also is kind of being pushed aside amid all the G7 noise. So let's look at them quickly together. I'm returning to this graph as a way to say maybe things aren't that bad, because if you look at this period of 2021 to 2023, 2020 to 23, and we average those global sales out, we're not down from pre-COVID. That's the least we can do, perhaps. So those downs and ups and downs again kind of average out to, again, reiterate my point that we're not seeing an upswing in growth. Besides that, we've got to understand the COVID experience as well from a consumer point of view. And for me, this gives the greatest insight to why we had such a strong recovery in the United States after COVID and why that has petered out. Because if you look at the savings that American households had during COVID, with the stimulus, with not going out, not spending on experiences, etc., the percentage of their disposable income that was saved reached really record highs, about 15%, whereas the average is around below 5%. Today we're at around 4.5%, and so again, we understand why there was this sort of spurt in spending on discretionary products such as jewelry. And so the industry enjoyed the fruits of that. Today we're seeing a return to the experience economy. People want to go out, they want to travel again, and they are doing so. There's this theory that we're kind of bracing ourselves for a bridal boom in 2024. Signet likes to put out this theory about, there's this lag in engagements. It's a cute story. I'm not sure if it's going to play out really, but let's wait and see. And what's happening on social media today is unprecedented, because and I feel it, maybe it's because I'm scrolling more these days, but I'm feeling it very strongly on social media that consumers are engaging with brands in a very different way, or maybe the other way around, that brands are engaging with their consumers and building community within that social media landscape that is really enabling them to add value and enhance their sales. And it's very much a branded play. And I think this is where the Natural Diamond Council, who's doing very good work in creating content about the diamond industry, but it's hitting a certain limit because it's not a brand. And so it's an interesting exercise to see how an organization that has this sort of generic mandate is trying to operate as a brand in this space. And I think it's hitting some limitations on that. We continue to see a frugal retail inventory management, and I think this year and last we are seeing, the slowdown in 2023, I think, was more of a China story than the US. The US is is stable. But the slowdown in China, I think the trade is feeling is feeling more. You know, when you hear about the quietness of the Hong Kong show, etc. I put in India here because I think India is sometimes forgotten as a consumer market, and it's the one bright spot I think that we're seeing in terms of consumer confidence in diamond jewelry. That we should not underestimate the potential for India to really lift the industry in terms of the consumption of natural diamonds. Okay, so I'm just going to go through very quickly each of these news items. In terms of the geopolitics, we dealt with the economics. Turning to the geopolitics, we've got the story about the sanctions targeting Russian goods, but let's put that aside for a second and think about the other elements of the implications that we're feeling. And probably the biggest news story that kind of wasn't noticed this last week is that Alrosa published its 2023 results. And lo and behold, their sales grew 9% compared to the previous year to $3.6 billion. So that's not a bad little performance for a company that's facing sanctions and can't sell into the majority of the market. Its net profit was down, but let's look at their top line revenue. Alrosa has a market for its diamonds. And so what are the implications for the trade? Are we going to be left with a two-tiered diamond market in which the trade has these two separate sort of products that are separated and are separated by provenance, essentially? What does that mean for the midstream? And how will that affect diamond prices? Will non-Russian diamonds sell at a premium to Russian goods? I don't think we're seeing that. We're not seeing that at the moment. Whether we will in the future remains to be seen. I think it'll be surprising if we do. But there's always been this argument that the traceability element enables companies to add value to their goods, and that's an important question as we look at the one of the results of this discussion has been the acceleration of traceability programs in the market, and that was gaining traction to some extent before the G7 story came about, but it was really driven by the brands who wanted to be able to show their source of origin and use it in the diamonds do good storytelling, which is what it should be used for, really. And so we return to the question of how traceability can add value for companies and the diamond supply chain in general. And my plea, I think, to the industry is to not forget this question in the noise of the G7 traceability mechanisms that are going to be thrust upon the trade, because the way to elevate the industry beyond those technicalities and the rules that we'll need to adhere to is to approach traceability in the way it was approached prior to this discussion, and that is using it as an effective storytelling tool. Okay, so the Botswana De Beers deal, they signed a new marketing agreement which basically will shift more of Botswana's production to Okavango Diamond Company, and so we have the emergence of Okavango as a major rough supplier in the market. That it's going to be, at the moment, Okavango gets 25% of Botswana production, but it's going to ramp up over the next decade to 50%. And what that does for Okavango that it couldn't do before is that it enables them to introduce contract sales similar to the De Beers site type of setup, and and in so doing they'll be able to allocate goods in Botswana for beneficiation. They weren't able to do that through selling diamonds by tender. They needed the contract sales, they needed the volume of the contract sales to invite companies, to incentivize companies to manufacture rough interpolished in Botswana, as De Beers has done. And so what we've seen over the last 2 years is that 20 new factories have opened in Gaborone. And that's, I was there a few months ago and I didn't know about that. And that's a tremendous amount of new factories, new companies that are operating. And so we've got to think about the impact that will have on India as a manufacturing hub. Because the Botswana government, I'm quite certain, wants all of its rough to be beneficiated, because it's very bent on. It's a political issue in Botswana. It's an election issue. That how the country can leverage its diamond production. There's a story in the background about HB Antwerp's position in Gaborone, the off-again, on-again deal between HB Antwerp and you've got this sort of issue of mining companies and rough suppliers adding or gaining a profit share in the polishing, and that's the deal that Lucara, Okavango, and HB, I think, are working on. And then there's, of course, the impact on De Beers. De Beers will have access to less rough in the site system, and so it's got to go out and find more rough. And so suddenly we have De Beers Exploration Company looking for new mining sites, and that's something we haven't seen very prominently in the last decade. That De Beers is back in the exploration game, and it's targeting Angola, as many others are, as a potential place for new mines. So what we're seeing through all of this is the democratization of rough supply. And if you think back to the early 2000s, when you saw the end of that that single track rough supply system that ended with the introduction of Alrosa, now we're seeing a much broader that diversifying even more. That there's a democratization of rough supply. And I think it'll be interesting to see to see how De Beers develops in the next decade. I think we're going to see a very different company than we see today, and possibly, I think I'm keeping an eye on Anglo American to see how they deal with the De Beers asset. That's not investment advice. Okay. All right. I'm kind of interested in this lab-grown diamond story, and I showed this little graph to the Israel Diamond Exchange. I spoke to the executive. I think it was in 2022, and this is a graph of innovation, the innovation adoption cycle. So a tech company brings their product to market, and there's various stages of development. And so I asked the question to you: at what stage do you think the lab-grown product is? It's called the Rogers Innovation Adoption Cycle. Rogers wrote a book called Crossing the, I never know how to pronounce this, is it chasm or chasm? Chasm. Right. And crossing the chasm being that once you've gone over that point, then it's found its place in the market, and if it doesn't cross the chasm, then it dies essentially. So where do you think that lab grown would be along this bell curve? Rami?
Dead center.
Dead center.
I think early adopters. I think
So I actually think that we're now entering the late majority stage. And when I asked this question to the Israel Exchange, we were more sort of towards the early majority, and that was just a year or two ago. And so I think, I say the late majority because I think the industry has reduced the stigma of holding and selling lab-grown diamonds. Most retailers are not debating the way they used to about whether to or whether not to, and there's no doubt that this product has a place in the market, has its place in the market. It's a fixture of the jewelry market. And so what's driving? But it's at a point where it is changing now. It's at a point where its own dynamic is changing. And so we see somewhat surprisingly over the last 2 or 3 years that bridal was the growth driver of lab grown. Today, what I think is happening is that that firstly retailers can't rely on lab grown to maintain their top line, so they're going to shift back to bridal. But there is a doubling down of fashion jewelry and on branding of lab-grown diamonds. And so we see various, as a side issue really, the features of the lab-grown market being this continued wholesale price decline that Mahir spoke about yesterday. And this brings me back to the need for margin in the midstream to have a need for margin to have a dealer market. And what we saw in the lab-grown market is that everyone jumped in as prices were rising, diamond companies, dealers and manufacturers, and we realized that there wasn't enough margin to create a dealer market. And so many of them over the last year or two liquidated their stock and got out of the game in the midstream. So you don't really have a midstream in the lab-grown space. What you have is many of the Indian manufacturers gaining a very strong market position in terms of their growth, and they've improved very much the quality of lab-grown technology that's used in India. And so, I know we're probably running a bit late, but I want to talk about branding in the lab-grown space, and I'm going to take a minute to show you a little video that I think is worth noting. And pretend you don't see the title of the video, but let's... Is the sound not working? Can we get the sound good?
The sound's probably going through the Zoom.
Should I talk about the Zoom first? I think it's on the Zoom.
The sound is going through the Zoom.
Stop sharing. Yeah.
然后这个颜色是不是就能共享？它在共享屏幕，这个用户共享。
哎，来个自动屏。
Give us a comment, Joe.
Can you get the sound? Let me carry on. No, it's not that. It's through the Zoom. Don't worry. Let's carry on, and then I'll see what time at the end to show it to you. Anyway, it's well worth noting what Pandora is doing in its marketing. It's something that is really. I don't see it in many jewelry brands or in the diamond jewelry space at all. Okay, and so the final story of 2024 is the sustainability challenge, and the challenge at the moment is that we're forgetting that we need to focus on this sustainability story in this whole noise of the G7 stuff, that there is an added value within the natural diamond space about how the three Ps, people, planet, and product, are enhanced through the diamond industry. And so what we find is that we have the same themes, different year, to paraphrase another saying, and essentially the midstream continues to be squeezed in this environment, and so that has a profound impact on the WFDB members, because dealers will continue to be squeezed due to the democratization of supply and the diversification of consumer interests and buying habits. And we must understand where the value that dealers provide lies within the market. And I think that the dealer market needs to reinvent its purpose within the trade. The midstream needs to embrace all means to enable greater storytelling with the industry, within the diamond industry, and that's I think our role, is that the midstream is an enabler of great storytelling, and that's something we often we don't realize about the midstream's position in the market. And so I think, in conclusion, when we're talking to WFDB members, we've got to understand, what is your story? Everyone's got to be asking, what is your story? And how are we telling that story? And where are you telling that story? And I think, for one, if I may, in all humility, the WFDB is doing a wonderful job on social media, with Harsh taking on a lot of the stuff, and it's very effective on Instagram. There are other platforms. I think that LinkedIn is a vital platform for the WFDB, because the WFDB is a B2B organization. From my viewpoint, you can maybe argue with that. But LinkedIn is the platform, and 2024 it's really the growth platform, particularly, and so powerful for B2B players, and to create a community in that space. And I think that's one example of a tool that we can use to tell this story and enable better storytelling within the diamond industry. So thank you so much. I appreciate your time and for giving me this opportunity. Maybe I can unplug and show you that cool advert from Aurora and see if it works this time. Zoom. Okay. Sorry, Sharon. We'll see you in a bit. I think the problem is with the connection to the screen. Anyway, I'll send you the link.
Martin, you would like to say something to the group?
Thank you. Oh, you yes. Say, sorry, I'm still absorbed in the.
They are part of the young diamond teams, so beautiful women for sure.
We want to make an announcement. Sorry, I should have done it yesterday. 11th of November, date for everybody's calendar. We're having the Dubai Diamond Conference. On the 12th to 14th of November, there's the JGT, the Jewelry, Gems and Technology B2B trade show happening in Expo in Dubai. We're also having the KP Culinary, so that whole week will be diamonds in Dubai. So welcome everybody. We'll be sending out information in the next week or so, as soon as I get back to my desk in Dubai. But everybody is welcome to attend, and we look forward to hosting a great event. So,
Thank you very much.
can I comment on this?
Yeah. If anyone has questions, I'll be happy to.
I mean, it was good summary.
It was a fantastic summary.
Yeah.
Yeah.
It was
And,
very good.
And with your permission, I'd like to actually share some of those slides with
Yeah.
Boris and people in the industry in Australia, because I mean, we know so much information, but you put it together, you summarize it, we forget how one thing leads to the other. And you pose some really good questions, and obviously the numbers tell the story. You know, I wonder what, I mean, you know, your stats up to 2023. I wonder what 2024 is going to show, as we all do. You know, whether you're going to get that dip again. You know.
Well, that is the question. I showed the average of the last 4 years, but it's not really a correct way to look at it, because it depends. If 2023 number is sustained, then the average doesn't really matter. The average is on the assumption that 2024 is going to reach that level of around 80 billion again. And I don't quite think
If you're one of the old guys here, I looked at the 2007 signature, which was the high point. I have a feeling at that time, I don't know if that came into the market at that range, if that figure was from Kindle's. Because in actual fact what happened then was that the beers and the miners were allowed the EU to actually hold goods and buy them. The whole line, they were allowed to stop it. I think at some point there was a change in legislation.
Our roads are the same spot. And what the beers did is they didn't hold goods. They sold to Tottenham, and then the beers had the effect of limiting their production. So it wasn't that they dumped the diamonds up. What you saw in the early part was the destocking.
The destocking of the destock.
Right.
That's what.
Well, that's
so you moved into adjusting time.
Yeah, that's what I was.
That's another element that not only were retailers holding inventory, but the mining companies were as well.
So now it's left amongst the midstream.
And so there's probably legacy going on that's still stuck in the industry.
Ahmed, you are leaving?
I think that's why we're seeing a decline in wholesale prices in actual. And so that was the hidden message here.
Thank you. Excellent.
Parents in law were sitting 2 lines behind him, each in a harmonic.